Good morning and welcome to the latest in the IMAP series of webinars. Today we're fortunate to be joined by Hawke as the moderator for this series of two webinars on how to get started, model portfolios, SMAs and MDAs. It's now my pleasure to introduce Hawke from Oreana as the moderator for today's webinar. Shane, over to you.
Thank you, Toby, and welcome to the first webinar of a two-part series, Where Do I Start? My name's Hawke, Head of Research and Advisory at Oreana Portfolio Advisory, which is an institutional-grade outsourced investment consulting and CIO service. As a division of Oreana Financial Services, we make available our services to both Oreana as well as independent financial advisors for their asset consulting and investment management needs. In particular, we work with advisors on their investment philosophies, investment committees, asset allocation, manager selection, portfolio construction, and communication needs. We also make available a Netwealth SMA today as a private label offering, as well as a range of other implementation solutions. Through our work, we have identified that managed accounts is an area that we're keen to consider to continuously improve investment governance. But given the range of implementation options available, there is no one-size-fits-all solution. With options such as model portfolios, SMAs, MDAs, there is no shortage of choice of implementation. Which brings us to this week's webinar series. Our aim over the two-part series is to help advisors to continue to learn more about the implementation choices available, the benefits of moving up the efficiency curve and improving investment governance for the benefit of both their clients and their practice. It's with great pleasure for me to introduce the presenters for today, who will be going through a short presentation before we open up for Q&A at the end of the presentations. First up, we've got Matt Heine, who's the Joint MD of Netwealth. Second up, we've got Toby Potter, Chair of IMAP. And third, we have Dr. Poole, Global CIO of Oreana Portfolio Advisory. Welcome and thank you to each of the presenters. Just with regards to the logistics for the day, as you may be familiar, feel free to send any questions to us via the Q&A function. We'll look to take questions throughout the session. The presenters may answer some questions throughout, but also at the end, we'll look to spend quite a bit of time going through the questions that you've sent through. So thank you very much, and let's get started. Over to you, Matt.
Thanks very much, Shane, and good afternoon, everyone that's dialed in. First of all, apologies that I'm slightly more casual than my fellow panellists today, being based in regional Victoria. This is the one good shirt that I have, so I did my best. But before we get into the topic and start really drilling down on what governance means and why it's so important when building out your managed account solution, I just wanted to touch on, I guess, some of the trends and observations that we're seeing in the marketplace at the moment as it relates to the different types of implementation, but also then the types of assets that people are using and then the benefits of why managed accounts are increasingly becoming so popular. So if we can just move to the next slide, please, Shane. Thank you very much. So as Shane alluded to before, there is an increasing number of ways that people are looking to build out their portfolios. And it's not just simply a matter of, do I build an SMA or not? There are a number of different sort of shades of grey, if you like, in between. So on the axis on the left, what we've attempted to do is to really just plot the different ways that we're seeing people implementing portfolios in their businesses at the moment. And more importantly, the little arrows are really the trend lines. So are we seeing an increase in usage or not? And I think the first thing is that whilst the orange square, so that those using bespoke portfolios, really do offer the most control, that is the vertical axis, they give you, unfortunately, the less or the least business efficiency. And less we're seeing advisors offering bespoke portfolios, that is where every client in their practice has a different portfolio, different asset types, depending on when they became client and what their specific needs were. So we are seeing less and less practices going down that path. We're definitely seeing an increase in those using model portfolios and in the Netwealth scenario, our smart portfolios, which generate automatic ROAs. And effectively, that's where clients, advisors are setting up maybe 5, 6 model portfolio templates, attaching clients to those templates, and then using the automatic rebalancing to rebalance across those groups of clients very efficiently, but still in a traditional advice environment and regulatory environment. To the side of that, MDAs, and no doubt definitely increase efficiency, The MDA license is harder to come across these days. And I think just because of some of the regulatory uncertainty, and Toby will talk about that no doubt during his slides, we haven't seen necessarily a decline in MDAs. We haven't seen an increase. We've seen MDAs continue and go sideways in many ways. The big growth and certainly a big part of our growth story at the moment is around private labels and the retail managed account offering. So in a private label scenario, advisors and wealth managers are able to establish their own investment philosophy and investment portfolios using an outsourced RE such as Netwealth, or in our case, Ironbark, and implement en masse their portfolios and those changes that go with running them. Under a retail managed account scenario, which is down the bottom, you get the least control over your client portfolios, but the most business efficiency because you're no longer responsible for managing the portfolios either. So both private labels and retail managed accounts is where we're going to focus most of our efforts today, but please feel free to ask questions as we go along. And as you can see on the chart on the right-hand side, in 2018, 39.3% of advice practices in Australia, of those surveyed in our Advice Tech report, had adopted managed accounts in their business for some or all of their clients. And in 2019, that had jumped fairly significantly, and I think one of the biggest jumps we've seen in recent times, to 43.5%. So there's definitely an increase in the usage across the industry. And if we move to the next slide, I think this also explains really well why post the early stage of the pandemic anyway, we've seen significant additional inquiries of advice groups and licensees looking to find out more about managed accounts. No doubt many of you on the call are in the same bucket, and looking to implement them fairly quickly. And the reason for that is fairly simple. They realised that having been through the last 6 months and tried to make the portfolio changes that they needed to, when markets were swinging with volatility somewhere between plus or minus 10 on any given day, it was really hard to deliver the outcomes to their clients that they wanted. And what this chart shows you, this is based on our managed account. So there's about 5,000 clients in the managed account, $6 billion. And effectively, what we've done is we've mapped the ASX 200 against the daily volumes within that managed account. So on a normal day, pre-pandemic, we were processing somewhere around 1,000 to 2,000 transactions. Now that could have been managed funds or shares. As we moved into March and markets started to become more volatile, we saw those volumes spiking pretty rapidly. And throughout the whole of March and April, we saw the numbers sitting at somewhere around 10,000 average, you can see the number there being 12,650. So between 10 and 12,000 transactions being done a day, up from the earlier 1 to 2,000. And you can also see the buys and sells. So it wasn't that everyone was selling, it was fairly balanced. On the 19th of March, which was pretty much the low point of the market, we processed an astounding 42,500 transactions. Of those, 70% of them were actually buys. So what this is really showing you is that because model managers were able to operate and change portfolios so quickly, in fact, during that period, March to April, there was 3 times the normal number of portfolio rebalances. They were able to de-risk their portfolios rapidly on the way down. And as the market started to turn and there were certain green shoots, they were able to take advantage of opportunities and buy into the market rapidly. Now, if you compare that to those operating outside of a managed account, very different experience for the clients and also the practice. So clients in the managed account were spending more time looking at data and working with their investment committees to make changes, as well as being able to communicate quickly and rapidly to their clients about what was going on within their portfolio. And if we move to the next slide. So on the basis that we're seeing this sort of big increase in managed accounts, and it's actually a trend that's been going for probably 5 years now, many advisors are then trying to understand, well, how do I implement a managed account into my business? And who are the clients that it's right for? And again, it really does come down to the business and what you're trying to achieve. But it's not that it's a solution or a product for small clients, because if you look at the chart in the middle, 40% of the funds under management in our managed account is actually is managing portfolios greater than $1 million. Now, yes, we obviously have a huge number of accounts also being managed at the smaller end, but it's really around advisors looking at the particular client segment, the needs of that segment, and then creating portfolios to service it. So for example, at the smaller end, it might be a very simple index-based low-cost portfolio, all the way through to the top end where it could be an active portfolio with international and domestic shares. Now, on that note, it is also worth noting, though, that within the managed account, 60% of our current assets within the managed account are still managed funds. So in many ways, it's the industry taking or building portfolios in the same way that they have for many, many years, but looking to wrap an automation wrap around it. And I think from a best interest perspective, that's really important to understand, because now through a managed account structure, an automated investment structure, you're able to implement the same changes across all of your portfolios. It's not a matter of working on your best clients first and working backwards, but you're not having to radically change the way that you operate. Having said that, and Toby will no doubt talk to this, as people become more familiar with the managed account and the operations of the managed account in their business, we are seeing asset consultants and also those advice groups starting to look at how they can implement direct equity portfolios, either that they manage in-house, where they pick their own stocks, obviously within an investment government process, or if they outsource that to another SMA manager, where they're able to partner with some of Australia's leading managers to fulfill that particular role in the portfolio. And skipping to the next slide, please. And going back to reasons why advisors are looking to implement managed accounts in your portfolio, again, based on our research, but it probably doesn't come as a big surprise, it's just that improved efficiency. So 73.7% of those using our managed account cite that as the #1 reason that they've implemented and continue to use managed accounts. On the flip side of that, though, and I think this is really important to note, that through the financial standard managed account research, they've also found that it leads to better overall outcomes for clients. So we started talking about execution alpha, and I know that Toby's got a great slide on this that just shows how by implementing at the right time and doing it in a really efficient manner, you can actually generate better returns for your clients. Improve practice efficiency, improve transparency for the client so they know what they're investing into. This is particularly evident when we're looking at managers that are looking at ESG strategies. And importantly, we also see many advisors looking at it as a way to lower admin fees for their clients through a number of different fee savings that you can get through a managed account. So I might leave it on that slide, and just on the final slide, talk about some of the additional benefits to an advice firm. And again, these have got really great client outcome benefits. On average, managed accounts are saving advice groups that use them 12.5 hours a week. So that is less time researching funds and actually doing the administration of those particular portfolios. And the beauty of that is that they can now use that time to look at either finding new clients and increasing their revenue, or equally spending more time with their existing clients to make sure that they can drive better outcomes, both financially and also from a strategic perspective. So there are an increasing number of reasons why you would look at a managed account in your portfolio. And the next couple of presenters are going to talk about what's actually required in setting up the portfolios and getting to this point where you can start to realize some of the incredible benefits and efficiency gains. So thank you very much, and look forward to answering some questions at the end.
Thank you. We might now hand over to Toby. Thank you, Toby.
Look, thanks very much, Matt, and thank you, Shane. It's a pleasure to be able to present and take part in one of these webinars for a change. It's great to see managed accounts now becoming such a central part of the way in which advice practices are conducted. And from the work which IMAP has done with a number of advice businesses, I've pulled out onto the slide here the 4 main reasons we see that advice practices and licensees decide to adopt managed accounts and the benefits that they get. And Matt touched on this in his extract from the Financial Standard research, better outcomes for clients. And I want to call out from that one particular point which we've had advisors talk to us about, and that is the continuous monitoring of a portfolio. The ability for an advisor to say to a client, this is the portfolio that I think that I'm recommending to you. This is the type of portfolio that I'm recommending to you. And if you go ahead with the service that I'm proposing, whether it's an SMA or an MDA, one of the things that you can be confident in is that it will be subject to continuous monitoring and continuous review to ensure that it remains on track for you. Then the second key point, and again, this was in one of Matt's slides, is the efficiency benefits. And that's traditionally been promoted as one of the key benefits for managed accounts. But of course, the ability to avoid ROAs for what are essentially routine or mechanical processes. From Matt's slide on the number of transactions that were done, In an advice business that I worked in previously, we used to estimate that an ROA cost us approximately $500. So if you think about Matt's slide of 42,000 transactions in a single day, that accounts for, what, $2 million of costs saved in a single day across their client base. It really is quite significant. Moving on to the control over investment processes. The advice business is going through structural change. We're becoming professionals. Individually, we're becoming professionals. But more importantly, the advice business is professionalizing. And one of the things that happens along that path is the desire and capacity of advice businesses to differentiate themselves, to be absolutely clear about what they stand for, about the services that they offer, about what it means to be a client of our practice. And managed accounts really are one of the ways of making the intangible, what's the service we offer, tangible. When you're a client of ours, this is how we manage portfolios. This is what we believe about markets. This is how we think portfolios achieve individual client goals. And the ability to say our CPI +5 portfolio is designed to work in this way. Our growth portfolio, our absolute returns portfolio, they're designed to have this type of return, this type of volatility, to hold this type of assets. This is what we believe about markets. A structured process makes it possible for an advisor to make these sorts of statements to their clients, and more importantly, to know that as an organisation, they can deliver on that promise. And then finally, and we're going to talk a little more about this, I'm sure, in the question and answer, the ability to recover some of the costs that are part of the advice process. If professionalism means delivering a more complete, a more structured, a more appropriate service, that comes with costs. And managed accounts, just as fund of funds portfolios are a way of delivering portfolio outcomes, managed accounts are a way of delivering a structured outcome. That has costs, and those costs are often going to be recovered through an explicit managed account fee. Let me talk a little about the types of managed accounts and the sort of, I won't go into this in detail, but let me just talk about the three main types of managed account. On the left, registered schemes. This typically the platform-based SMAs. In our last fund census in June, that's about $28 billion. And this has been traditionally one of the faster growing parts of managed accounts over the last couple of years. In the middle, MDAs, still the largest part of the managed account market, and I guess the most traditional. Ever since ASIC brought in the class order in 2004, that's been the original structure for managed accounts. And then there's always another. Other in this case is IDPS-like standing instructions, trustee discretion. That's the smallest part of the market. And here's how they've compared with each other and how they've grown 6 month by 6 month period from 2017 when we started the fund census process to June, and we'll repeat this again in December of this year. What's impeded the growth in managed accounts over the last, say, 12 to 18 months? Well, the Heine Royal Commission, there was no doubt that led to advisors reflecting on what its outcomes might have been. In February, when the results and the recommendations were made public, we also had ASIC continuing to conduct MDA and platform review, and we might talk about that a little later. Then COVID. Many of you will have heard of that. That's had quite a significant impact on the conduct of advice practices and the time that particularly those advisors who are also involved with accounting have had to dedicate to the financial planning part of their practice. Now, in wrapping up, I want to talk about one final critical point. Do managed accounts deliver? Does it work? Is it something which, given that we're talking about the uncertainty of future outcomes, an advisor can say to a client, I believe this is a better way for portfolios to be implemented. What I've got on the screen here is some work which James Freeman, who's the head of investments for Philo Capital, an organisation that I've got an association with, did to try and quantify the benefits in implementation terms that a managed account, regardless of type, whether it's an SMA or an MDA or one of the other types, that a managed account might deliver for retail investors. So the assumptions are this. This is looking at asset class level decisions. This is going back 20 years to 2000 and modelling actual market returns in a stochastic way, assuming that the portfolio manager made 6 calls a year and got just over half of them right, 56% of their calls right. So over a 20-year period, what would have been the experience for clients? Well, imagine the investment committee makes the call, oh, we're going to make this change. And as I say, there's a 56% chance that the call is right. If it's a managed account, that decision's likely to be implemented within a day or two, within a week, certainly. If it's being implemented by an advisor, writing an ROA, sending the ROA to the client, waiting for the clients to return the documentation, implementing the transactions, waiting for the cash to come back if it's a managed fund, then sending it off for the purchase, for the application for the next fund, there's a considerable delay. James's analysis says if a 56% correct decision is implemented 4 weeks later than it was made, so that's a month's delay, which is pretty common in a larger client base where each transaction is being executed through an ROA process. 50% of the benefit that would have accrued from making that decision, this is going back 20 years, this is looking at 20 years of data, 50% of the value of that decision's lost. And if it takes 13 weeks, almost all of the value of that decision is lost. So James's analysis shows that managed accounts, precisely because of their ability to implement in a timely way the decisions that are made in a structured way, that this adds real value to clients. And in the session that Isaac is going to talk about, a lot of his presentation is going to focus on how decision-making processes can be improved. But James's analysis here talks about how the benefits that implementation efficiency can provide really are delivered through managed accounts. So Shane, thanks very much for the opportunity to take part in this. Back to you.
Thank you, Toby. And yes, let's now move to Isaac, who's the next presenter.
Thanks, Shane, and thanks, Matt and Toby. I think, Toby, that's a really useful way to kick off my bit of a talk. And after all, this webinar is about getting started on SMAs and MDAs. And what I wanted to talk about is really one of the critical parts of getting started. And from our perspective, successful investment management just cannot exist without a clear governance framework. So even before you think about how you're going to operationally manage money, you've got to start thinking about what your governance frameworks are around managing that money. And it's really the secret sauce for consistently and successfully delivering returns to your clients. And from my experience, this focus on governance has been the secret that the really big asset managers and the supersized sovereign wealth funds and the biggest asset owners globally spend lots of time thinking about. They all know that none of the actual managing side of things can happen without a clear governance framework. It's that critical. And these supersized sovereign funds and asset owners spend literally millions of dollars each year on getting governance right initially. And then they spend further millions of dollars each year on making small incremental improvements that they expect will continue to help deliver good returns. So I'm going to use my few minutes to let you know what they do when they're talking about that, and how they do that, and why they do that, and why it's so important. So I'll kickstart by explaining what is governance on this slide. And we have a pretty simple view of governance. For us, governance is basically the effective use of all of the resources at your disposal to fulfill a fiduciary duty and achieve an underlying investment objective. Now, when I say all of the resources, I mean all of them, and that includes the people that you have working with you. It's the policies you have in place. It's the processes you use to implement those policies, and it's the technology and the systems that you have at your disposal and at the disposal of your business to run that framework. And it's you can see from that definition that governance is really important because it focuses on achieving an investment objective. And after all, that is what we as wealth professionals and investment professionals are charged with doing for our clients. So if I sort of think, why has this become such a big focus? Well, it sort of started back in the 90s when some of the largest pension managers globally, and here I'm using the experience of some managers in the US, were asked, what is it that prevents you from actually achieving good performance for your clients? And it turns out that really the answers that they gave were linked to the big governance issues. You see here that the respondents, 98% of the respondents said that not having the right processes was a barrier to better performance. The resources and people, 48 and 35% respectively, policies and the investment mission, identifying all of that, 43% said that not having that in place was preventing them from getting better returns for their clients. And it was this realization globally that around that time we started to see institutional managers really starting to dig deep into the importance of governance. And from that point onwards, we started to see reams of academic research, loads of practitioner research, regulators really focusing in on it, and it became a really critical issue. If we go to the next slide, I'm going to follow up and just drive home the point in the time that I've got, that governance is not the same as investment expertise. They're complementary, but you shouldn't conflate the two. They do need to work together to achieve a coherent and clear investment objective. But you need to get the governance right, and then you need to get the investment management expertise right. And without all of them working together, you're not going to get the best outcomes for your clients. And so from our perspective, we think about this in a series of layers, that you need to get right. And there's three of them that are really important for us. We think that good governance will involve a broad oversight body. And that broad oversight body is going to have a critical role in providing clarity around the roles and the responsibilities of the resources that are at their disposal. but they'll be focusing on bigger picture issues and the long-term issues and looking at ways that they can improve the governance framework through time that will filter through to better outcomes. Then the next layer is the investment committee, and I think a lot of people on the webinar will be familiar with investment committees, and they may have investment committees to some extent, either formal or informal. But you know, from our perspective, this is an area where the businesses that we've worked with have identified that they do want to improve that process. They do want to be able to really show that there's a clear investment committee that is helping them with that management process and reviewing the management of the portfolios themselves. And then the third part, after you've gone through an oversight and a investment committee, is the actual implementation and management of funds themselves. And I guess the experience that I've had and the experience that I've seen is that there's a lot of money and time and resources put into number three, into the actual management of the money itself. But the numbers 1 and 2 have kind of been left behind a little bit and not had that same level of focus. And for us, when we look at this, we see that that's where the really big gains can be made initially, very quickly within a business to really beef up the governance framework and then really deliver better outcomes for clients. And after all, it's that's the critical part of governance, which I'm going to get to on the next slide, please. You know, the initial point that I made, that there is millions and billions of dollars annually spent on getting governance right by very large institutions, and significantly less, as I mentioned in the previous slide, amongst the wealth professionals globally. And so why is that so critical, and why are people spending so much money on it? Why are they willing to commit to this cost and investment in governance? And look, the simple reason is that good governance and good governance frameworks is empirically and provably a driver of long-term returns at the client level. And to put that really clearly, good governance and good governance frameworks adds value to clients in terms of returns. Poor governance destroys value in terms of returns, and this is over the long term. And to give a concrete number to that, so you get a sense of the quantum, the research is sort of indicating that between 100 and 300 basis points over the long term can be added by implementing and focusing on really good governance frameworks at the business level. And that is a significant return on the investment of implementing these frameworks. So from our perspective, that means that if you're an investment fiduciary, you absolutely have an obligation to invest and think about those governance frameworks and to review them each year and to work on getting a really clear best practice framework. And that's how we think about it. You know, the best governance frameworks, we call them best practice stewardship on this slide, they're going to deliver better outcomes for clients. They're going to be a way of improving the wealth profession. And that's the case whether you use an SMA, whether you use an MDA, whether you use bespoke models. These governance frameworks sit absolutely at the heart of everything we do. And that means, again, that if you choose to focus on good governance and you start thinking about what best practice stewardship means, it means having a really clear, documented set of policies with really repeatable and consistent processes, and they should be implemented by experienced individuals in this area, and that is going straight back to our definition of governance that I spoke of before, and that is what's going to help work towards better outcomes in your client's best interest. And it's more than just an investment committee. It's more than just having a set of investment beliefs jotted down somewhere on the website or on a document. It's living and breathing them. And we've been really fortunate over the last couple of years that we have found a lot of businesses are very keen to begin this journey. They've been very happy with the results that have come out of it. But that pathway to great governance absolutely slots into this, where you should get started if you're thinking about SMAs and managed accounts in that process. Yeah, and that's going to translate into the outcomes that Matt and Toby have spoken about. So I'll close there and just finish with the idea that, you know, we think governance is so critically important that we have written a white paper on the topic. It's going to be made available to everyone on the webinar afterwards, and you know, that hopefully will complement this and go into a little bit more detail and richness around what governance might mean for your business and how that might link to your implementation decision.
Okay, thank you. Thank you very much to the presenters. We've now concluded the presentation section, and we're going to move to some Q&A. There are some questions that have come through, which we will look to answer. But first up, I might just ask Matt and also Toby as well, just to get your thoughts on something. So, if I am in that position where I'm keen to look at some of the issues that you've highlighted around improving efficiencies, engagement with clients, and basically better outcomes, where do I start in terms of engaging with an SMA or a managed account, MDA, etc.? What's the size of FUA that I need? What's the capability that I need to have? The costs potentially that are involved. Could we have a discussion just on some of the real practical considerations, maybe kicking off with you, Matt?
Yeah, absolutely. And thank you, Toby and Isaac, for your two presentations. I thought they were really informative. And I just wanted to probably reiterate both the points that, again, going back through the experience through the pandemic, that governance piece and the execution piece, but particularly governance, being able to provide reliable, repeatable and consistent outcomes for clients, that's what can really build trust in a client base. And having that ability to also have a framework so that when the market is capitulating, that you've actually got the conviction to make the changes that you need. And we heard that firsthand from a number of our clients, actually, that had they not had an investment committee and had not had the governance structures to support their private label, they probably wouldn't have made the changes that they did, and that ended up actually delivering some really great returns and outcomes for their clients. And then obviously, to Toby's point, being able to doing it quickly and efficiently. So I think hopefully everyone on the call is now sold on the need for a managed account. The first thing to do is clearly to get the governance structures and the investment philosophy nailed down. Until you get that done, the rest of it really is fairly academic. And there's a number of different ways you can go about that. So investment philosophies can actually be very hard to implement. I speak to a lot of practices, and whilst people have their sort of foundational beliefs, and they broadly know if they like active versus index and tactical asset allocation versus dynamic, when you actually go to sit down and write down all your beliefs and pull it together into an investment philosophy, it is actually quite a challenging process. And so what we would certainly suggest in that process is engaging with a consultant like Oreana and actually sitting down and having that conversation around what is the structure of the investment committee, where can a professional add value? Is it through asset allocation? Is it through asset selection? Or is it actually to help you with the whole process? And then once you work through those sort of foundational pieces, that's when the real fun begins. So for us, we require a full FSC document. And effectively, the FSC document is it's a very detailed document that asks a lot of questions about all the things that we've just talked about. Now, the way that I've often explained it is that as an advice firm, if you think about the process or the rigor that you put any new manager through before they end up in a portfolio, that is the same rigor that we're going to put any new portfolio manager through on our managed account, because it is a professional investment service. And as RE, we have all the same responsibilities as does a RE of a managed fund. So it's not for the faint-hearted. It is a lot of work, and it requires you to be crystal clear on your governance and in your investment philosophy. From a size perspective, again, there is a lot of cost in setting up a managed account, particularly a private label. So, all of the things that we just talked about, the due diligence, the review, the establishment, there's expense both for the investment manager, but also for the managed account provider to make sure that it ticks all the boxes and goes through the relevant committees. So we typically say that an advice firm needs to have in excess of 100 million if they were to run ballpark five models. It averages out at around that $20 million per model, but often you'll find more in the balance than, say, a moderate. So collectively, we're looking for about $100 million or more over the first 12 to 18 months. That makes it a viable proposition for us and also for the advice firm. Outside of that, and again, we're seeing good demand in the off-the-shelf retail menu. If you don't quite have that sort of size, or you're not ready to put in all of the processes required, it's a great chance to get to understand managed accounts, use the retail menu, and then migrate across to your own private label as and when obviously the business can support it. But it's a lot of work, but there is clearly the reward is at the end.
It's amusing to me to hear Matt talk about $100 million, because when I set up my first managed account business in 2005, I came to the conclusion then that if you didn't have $100 million, I couldn't help you, and it remains true today. But as Matt said, the supply of portfolio managers like PAS or the sort of public offer SMAs on platforms is such now that for an advice business that's smaller in size than that, there really is an opportunity to work with PAS for your standard portfolios, for example, or with the menu of their preferred platform. The other point I'd make, which sort of reinforces Matt's point, is that particularly for smaller advice businesses where the business owners or the advice principals are also advisors, you have to ask yourself, what is the best use of my personal time? If you are that advice, if you are the principal of that business, what are the areas in which I can add most value to the creation and growth and sustainability of this business? And while many advisors, actively enjoy being engaged in the investment process, stepping back as a professional business owner and thinking, where is that place in which I personally can add most value? Often it's in outsourcing the investment decision-making process. So does that answer your question, Shane?
Yes, no, that's great. It's good. So maybe to Isaac then, just on that just with the service of the Oreana Portfolio Advisory Services, is there standard portfolios or can there be specific portfolios tailored to different advisors' needs?
Yeah, so PAS has a range of standard portfolios available as SMAs with Netwealth right now. These are a range of portfolios that we've built out using our processes and our philosophies and our beliefs, and going through that governance framework to deliver a range of portfolios that we think are applicable and usable for a very broad range of clients. And we worked very hard on them, and we're very comfortable and confident about their ability to deliver on the requirements of a very wide range of clients. Now, that having been said, we are an asset consultant as well, and we are able to work with other groups and advice businesses on a range of different areas. So, the separating, as I mentioned in my slides, separating out that investment governance from the investment management itself, I think is really critical when you walk down this pathway, because you're going to have investment governance expertise, and as Matt mentioned, you're going to have to know really clearly what your beliefs are and be able to implement them and know how they will interact with the operational side of what you're looking to do. You need to have a great investment committee and know what that's going to do before you even get started. And then once that's in place, you're going to need someone, if you want to do that yourself, to implement and make the decisions and manage the portfolios. And that's not easy. Matt made the point that it's the same level of due diligence from his perspective as he would do for any of the very large institutional investors who have a whole lot of resources to be able to do this. So while it's possible, it's not easy. And so PAS does offer that consulting service. We've worked with groups on investment belief workshops, and we've helped them build out their own philosophy and beliefs. We've worked with businesses who are using our SMAs to build some more bespoke portfolios that may be more relevant for a specific segment of their client. And so yes, we do have a range of SMAs available, and they've been going very well, and we're happy with how that's working. But we are here to help in a more broad sense across the business.
Thanks,
I think there's an important point that probably hasn't received quite the airtime that it ought to have, and that's something that comes out of FASEA. I mean, when I look back on the implementation of FOFA, for example, which was promulgated in 2012, 2013, and is only really now absolutely embedded, sort of 7 or 8 years later. FASEA, I suspect, will have the same lead times. Now, standard 10 in FASEA, and there are plenty of problems in FASEA, but standard 3 in particular, but standard 10 says to an advisor, you have to ensure that you have the relevant skills and maintain and apply those skills in the provision of advice. And I think we're going to see over a period of time, and I suspect this is a number of years, we're going to see that standard tested as clients, particularly if we go through a period of prolonged market turmoil, as clients complain and end up in the single monitoring body, if we ever get one, when we get one, testing out for individual advisors, did you personally have the relevant skills in the portfolio construction, given my personal circumstances and so on and so forth? Managed account actually, by drawing a line under the advice, in many ways provides almost the best possible protection that an advisor could look for, even if they're involved in the portfolio construction process. FASEA, like best interest duty, leaves many advisors completely exposed. And managed accounts provide one of the best defense mechanisms that I think is available.
Thank you, Toby. If you've got some more questions, feel free to send them through. Thank you very much to everyone that is sending questions through. It's much appreciated, and we will work through these for you right now. And if we haven't been able to get to them all, we certainly make ourselves available to answer them after the session. But I have one here for Matt. And it's with regard to if you are an advice firm, and maybe looking at the perspective of how many advice firms have got through that FSC process with Netwealth, and does it require an external manager with the relevant experience or not? And attached to that is fees that allow an advice firm charge where they are the private label. So Matt, a couple of questions there, if you wouldn't mind.
No, some good questions there, and sort of good segue from the previous conversation. I don't know the exact numbers off the top of my head, but I think through our private label offering, so the solution whereby advisors working with consultants, etc., can set up their own investment philosophies, I think we've got about 180 models now, maybe getting closer to 200. So there has been a lot of groups that have been through that process successfully. I don't think anyone's failed per se, and the reason I say that is that we do have a very consultative approach up front. So before groups go and spend a huge amount of time and effort filling out an FSC document and going through that process, we want to make sure that we can triage it and identify if there's any gaps in the skills, and where there is, partner them up with, again, people like Oreana to make sure that when the document finally does get submitted, that it goes through with no problems. So if I think about the current construct, as far as that skills gap goes, of the private label offering, around 85% of the models being offered would be through an asset consultant, through a professional asset consultant. So it's a very small number, 14, 15% of firms that we work with where they've got in-house capabilities, whether that's stock selection, etc. And the reason for that is really one of scale. So as you would know, investment professionals are expensive, and to have a team of investment professionals on your...
Thank you, Isaac.
on your team, it can certainly grow the salary. Sorry, all my kids have just barged in. One sec.
I made a point of putting the dog outside when we started that. She's a snorer, and these are very sensitive microphones.
Sorry about that. Apparently, I got a parcel from the post office, which was more important than this webinar. Sorry. So, so 14% of people have got their own in-house investment committee, and that really is a cost thing. You need to have significant scale to support a well-rounded investment committee internally. So, so certainly, the bulk of them, or the majority of people we work with, are in conjunction with asset consultants. As far as fees, it's probably a whole topic in itself. I'll sort of go back to basics on this, and it's a pretty easy question to ask oneself: is it a fee for service? So is the fee that I am collecting appropriate for the services that I'm delivering? Because if it's not, then it's a pretty straightforward answer. So many of the private labels that we're setting up now are what we call fee-free, in that the advisors have chosen to use managed accounts as a really efficient implementation tool, and they'll make their fees through the traditional advice component. But at the same time, we also do have many professional portfolio managers that would be charging somewhere between 10 and 20 basis points, potentially more if they're doing sort of individual stock selection for that service. But ultimately, it just comes back to that base question, which is, what are the services that I'm delivering for the fee that I collect, and are they appropriate? And that's the same for any fee in this industry.
Yeah, it's sort of that standard expression that you see in so much of what ASIC publish, which is fair, reasonable, and value for money, and that's a measure that we see being applied in lots of areas, not least the fees that are charged for managed accounts of all sorts, SMAs, MDAs, and so on and so forth. I think there's little intellectual mileage in suggesting that just because a portfolio is put together by a business which is primarily an advice business, they aren't entitled to charge for the service that's provided. But as Matt said, I think this whole process that we've gone through of the Royal Commission and ASIC's heightened attention to the advice process means that phrase, fair, reasonable, and value for money, is one which is being taken extremely seriously.
Thank you. Thank you, both of you. Maybe just on the structures, there's a question here just on outside of currency, are there other considerations between using an Australian equities SMA and an international equities SMA as part of the overall managed account structure? So it's a good question and an important one, because I think we're seeing there is more investment choice, there's more investment options available, and the structure of managed accounts is providing that umbrella over a lot of that capability. Maybe a question to both Matt, Toby, and Isaac, if you have some comments as well from investment governance or investment expertise. What's the trends in the investment universe and the investment structures, and what should I consider about looking to continuously evolve my portfolio offering?
Maybe happy to go first on that if you like, or
yep.
So look, there are definitely a number of considerations, and I'm sure the other gents will cover off on a couple of them. Probably the main one that I'd call out is that bringing international equities into your portfolio. So I'm not talking about ETFs here, I'm talking specifically stocks. Whilst there's clearly a lot more research and investment research that needs to go into selecting them, it also potentially makes it very difficult for smaller portfolios. So the reason for that is that in America, it's not uncommon to have a stock, Facebook, Apple, you name it, where the share price is north of $1,000. And if you try and divide $1,000 into anything, it doesn't go very far. So it's very hard to get a broad diversification within a portfolio without having much higher portfolio value. So that at the moment seems to be one of the big sticking points for us. Having said that, we are seeing a lot of growth in international equity trading in general, but through managed accounts, it definitely is affected, just because if you're holding 2 or 3, 4% in a particular stock, you do have to have a very large portfolio, given that the international equities is only maybe 20 or 30% of that broader portfolio.
We're running a webinar series, IMAP's running a webinar series next week on international equities as a component of managed account portfolios. And the first session in that actually looks at the logistical issues that Matt's just touched on, and the benefits or otherwise of including direct equities or ETFs. And we'll be using, involving Mark Thomas, who's head of operations from Morgan Stanley, who have a, as you might expect, a pretty high net worth client base. I'm talking about exactly these issues of what is the best way of achieving exposure, even for very large portfolios, to get diversification across direct securities can be quite a challenge. Isaac, I don't know whether you, with your kind of multinational client base, have a view on what clients expect.
Yeah, look, I just on the question, I know it sort of said, aside from currency, aside from FX, I mean, the reality is that is such an enormous part of investing outside of your home country that it is sometimes easy to sweep it away and just say, oh, it doesn't matter, we'll just have a set hedge ratio and that's it, and there's nothing else to worry about. We're seeing, as a bit of a trend, a growing interest in reducing home country bias here in Australia. The same thing is happening globally. The home country bias is a global phenomenon at a retail level and also at an institutional level. The FX side of things is difficult. Hedging decisions should not be taken lightly. And so, I sort of always suggest to our clients, don't just sort of assume that you can sweep that FX side away, whether it's an SMA, whether it's a managed account, whether it's a managed fund. These are really critical issues and really should be considered alongside the implementation.
Thank you. And just conscious of time, we've got a few minutes to go. Look, I do want to take the opportunity to thank the presenters today. It has been a fantastic opportunity to hear from you all with regard to your views on how you get started with managed accounts. It's certainly, from my perspective, I've seen this trend over many years, and it feels like it's really starting to gather momentum. And I think some of the discussion through today, the notes that I've taken, is there's a lot of choice available to you. And we've heard from the presenters on what's available. They're suitable for all clients. So there is something there for all your client base. We've proven both through the commentary from Matt and Toby around how important and effective it can be in terms of managing the client outcomes. And obviously from Isaac as well, in quantifying that from a governance perspective. There's a lot of efficiency clearly for the advisor and importantly, a lot of benefit for client, as well as an improved in client engagement as Matt took us through. So look, I do want to take the opportunity also to once again thank the presenters today, but also to highlight that we have another webinar in 2 days' time. And that webinar will be focusing in on MDA. So I know that there's a question there about MDA, so we'd encourage you to come along to that session as well. As we've said from the outset, we're really here to try and provide some further education and continuous information around the choice that's available. And no doubt through today's presentation, I think we can all see that there's a lot of choice. And a lot of ways to look to get started to improve the investment governance and also the outcomes for clients through managed accounts. So I will look to end the session there and thank you very much again to Matt Heine, Toby Potter and Isaac Poole for a great presentation today. Thank you again. We've got a copy of the slides that will go to you. We've got a white paper that we've written That's the Oreana Portfolio Advisory Service on investment governance. And we'll also have a checklist as well to help you get started. So thank you very much, and we wish you all the best for the rest of your day. Thank you.
Great. Thanks very much, Shane. Okay, thanks.